Hello everyone, my name is Muhammad Akbar bin Ambo and we from Group 9 will present our topics which is risk management. So I will present regarding the introduction. First of all, risk management is the identification, evaluation and prioritization of risk followed by coordinated and economical application of risks to minimize, monitor and control the probability or impact of unfortunate events or to maximize the realization of opportunities. Risk can come from various sources, including uncertainty in international markets, risk from project phases, legal liabilities, credit risk, accident, natural causes, and disasters. Risk management is the process of identifying, analyzing, and accepting or reducing uncertainty in investment decision in the financial world. Risk management basically refers to the process by which a fund manager or investor assess and makes an effort to quantify the possibility of losses in an investment, such as moral hazard, and then decide what course of action.
Next, objective of risk management. There are two categories of significant goals in risk management, which is pre-loss and post-loss objective. Pre-loss objectives are important objectives before a loss occurs. The objective include first, the economy. This implies that the business should make the most cost-effective preparation for potential loss, and second, reducing anxiety. The risk manager and key executive may become more alarmed and concerned by specific loss exposure. And lastly, meeting legal obligation. For example, the government regulation may mandate that a business should install safety equipment to safeguard employees. Next, next objective of risk management is post-loss objective, or known as an objective after a loss occurs. The objective include in post-loss objective, first, the survival of the firm, which is the ability of a business to continue operating after suffering a loss. Second, continue operating, which is the capacity to continue operating after a loss. And third, stability of earnings. Fourth, the continued growth of the firm, which is a business can expand by creating new products and market. And lastly, social responsibility. This objective is to lessen the impact of loss that have in individuals and society.
Next, we move to the benefits of risk management. One advantage of risk management is its ability to foresee potential problems which result in a shift in an organization's culture. It is because risk management carefully examines each of their operational procedure and consider what might go wrong. By risk management, companies know what to do either to put more money in per project or vice versa. Second, risk management will keep catastrophe at bay. Company must get ready for any kind of shocks that will impact the company with potential severe consequences like bankrupt. With risk management, it helps businesses to get ready for that. Third, maintains competitiveness. Business with risk management can reduce their loss. When an unfavorable occurrence happens like recession, company with good risk management procedure can continue to operate because they have their backup. Because of this, companies continue to become more competitive. Furthermore, business process can be improved with risk management. Company must always gather more data and their procedure and operations due to an ongoing process of risk management. With this, company able to pinpoint the steps in the process that are effective or have room for improvement. Last but not least, risk management will improve budgeting capability. Companies that have risk management procedure in place have good financial management than companies that don't have risk management procedure. This is due to the fact that they frequently examine the financial data carefully and attempt to eliminate any waste. Then, they can develop more effective budgets that can allocate money in the most effective way.
Assalamualaikum and salam sejahtera. My name is Abdul Rakib bin Muhammad Arshad. My metric number is BB201105114. So, there is three common ways used to measure investment risk. Firstly is volatility. Volatility measures how much returns fluctuate around an average return. It uses standard deviation to approximate the risk. The higher the standard deviation value, the more the assets fluctuate, which means the asset has a high volatility risk. Standard deviation formula is square root of total of number minus the mean divided by sum of number minus 1. Secondly, maximum drawdown. Maximum drawdown seeks out the largest movement from a high point to low position before achieving a new peak. Maximum drawdown formula is true value minus peak value divided by peak value. Meanwhile, for the last way to measure risk is Sharpe ratio. Sharpe ratio allows investors to see how much returns they are going to get by the amount of risk they take. It also uses standard deviation to approximate risk. The higher the Sharpe ratio, the more reward are awaiting. The Sharpe ratio formula is return minus risk-free of return divided by volatility. And that's all from me. I will pass it to the next presenter. Thank you very much.
Next is the intrinsic value of a stock. The intrinsic value of a stock is the sum of all of the company's future cash flows, which are discounted back to account for the time value of money. There are three common models for finding the intrinsic value of a stock, namely the dividend discount model (DDM), residual income model (RIM), and the discounted cash flow (DCF) model. So the first one is the dividend discount model, which is based on the net present value of the future dividends, assuming that the company in consideration is within a steady state, that is, withdrawing dividends into PPP. So the model can be expressed as follows, where P is the present value of stock, D1 is the expected dividend 1 year from the present, R is the required rate of return for equity investors, and G is the annual growth rate of dividends into PPP. The second one is the residual income model, which derives the intrinsic value of stock based on the difference in earnings per share and per share book value. And the model can be expressed as follows, where BV0 is the current book value of the company's equity, RIT is the residual income of a company at time period T, and RD is the cost of equity. And the final model is the discount cash flow analysis, where the intrinsic value of a stock is based on the projected future cash flows. So the model can be expressed as follows, where CFN is the cash flow in period N, and D is the discount rate or weighted average cost of capital, WACC.
Continue with the rules of investing. So first and foremost, to invest in a company, understanding on the overall company had to be prioritized. To analyze a stable company, wide aspects need to be taken into consideration, in which they offer a great product, excellent leadership, and especially a good financial statement. Next is the time value of money. Compound interest influence the growth of money, as the interest is calculated on the accumulation of interest over time. As the starting amount of money is higher, the investment return also rises with a faster savings compound. Next is the rational decisions. When making a rational decisions, individuals shall not be driven by the emotions and personal feelings. Greed will also cause an individual to lose much more money that could possibly earn. So for such in the COVID-19 era, the uncertainty has created a panic in the market that led a lot of investors to sell their investments and scared off other investors from buying, which resulted in a significant crash in the market. So we have the strategy involved, which is buying at a low price and sell at a higher price of stocks. Stocks tend to move upwards and downwards. They provide stake in the company, where every time the company makes a profit, it has to send shares of the profit, which known as the dividend. Lastly is individuals' perceptions shall not only focus on the investment tools. Although they are a great investment tools, they will not always be a perfect choice. Investment tends to come with different shapes and sizes. The businesses that had in mind might also be the best investment specifically for an individual. That's all from me. Thank you.
So, in conclusion, the risk analysis process help the organization run effectively and efficiently by identifying the hazards that need management attention, prioritizing risk control measures based on how much they will help the organization will be necessary. The extent to which the risk will be either removed or decreased by the suggested control methods is the measure of internal control effectiveness. One method of obtaining financial protection against the impact of risk is through risk financing, which includes insurance. Only on rare occasions can a risk be reduced at a cost that is wholly disproportionate to the risk. A reporting and review system is necessary for effective risk management in order to guarantee that risks are properly detected, evaluated, and addressed. That's all from me. Thank you.